Okay, the last step in the process then is when after we finish the job, we then transfer it, we sell it, right? So we complete the job and then we sell it. So when we actually complete the job, it goes from work in process into finished goods. Okay, so that's and remember what went into work in process is our direct materials, our direct labor, and our manufacturing overhead. So all these guys went into work in process. Now the job is done. We've added in the overhead. It gets transferred to finished goods. So the journal entry to that one, again, is the stuff just moves. I mean, as it physically moves, we need the counts to match that too. So it goes into finished goods inventory, so that's our debit. And it comes out of work in process, so that's our credit. So this one's fairly straightforward because it kind of matches, what it's doing. And so everything, again, what went in here is our allocated overhead. So everything that was on that job cost record, that's the total cost that's in there. And then it'll be the total number from that job cost record. So, job cost record, okay? Then once we sell it, it comes out of finished goods and it gets into cost of goods then. This actually looks just like a sale would have looked back when we were doing a merchandiser. So when we sold it, remember there was 2 steps in there. If we sold it on account, we have a debit to accounts receivable and a credit to sales revenue. And then the second part was the inventory going out. So it was a debit to cost of goods sold. And last semester that would have been a credit to merchandise inventory, but now it's finished goods inventory because that's where this one's coming from. And I know it's probably been a while, but if you remember, these two were not the same amount, right? So let's say we sold it for $1,000. That's what we charged the customer. But what it cost us was $750. I don't know. This is the number that would come from up here. So we put it into finished goods here, and then the difference is the markup. So this is what the customer paid, and then the $750 is what it cost us to produce it. Okay, so those are the last 2 steps of the job, and those aren't. I don't think there's anything too crazy there. If we do one of these, Lincoln completed jobs that cost $38,000 to produce. In the same period, they sold jobs for $88,000 that cost $42,000. This is not the same transaction. I feel like it would have been a little bit more. I think it would have made more sense to actually just do one thing that they completed and then sold, but we're not doing that. So this first one here, this is what's going from work in process into finished goods. And then the second one is what they actually sold then, okay? So for the first one, we'll debit finished goods inventory for $38,000, and we'll credit work in process inventory because it's coming out of work in process and going into finished goods. So that's the first one. The second one says they sold something for $88,000 and what it cost them was $42,000. So $42,000 is what went into finished goods, but we're going to turn around and mark it up and sell it for $88,000. So for that one, as long all sales are on account, so we'll debit accounts receivable, credit sales revenue for the amount we sold it for, which is the $88,000. And then we will debit cost of goods sold, credit finished goods inventory for what it cost us to produce it, which is the $42,000. And so that's all there is to that one. So everything we've done so far in this chapter is going on all throughout the year. Every time we get a job, finish a job, sell it, all that kind of stuff keeps. And in job order costing, this stuff is not going to sit in finished goods for very long. These are all special order things, so as soon as we finish it, it's going to go back out again. Now, at the end of the year, then, we're going to look and we're going to see that there's a balance in manufacturing overhead. So in this example, over on the debit side here, we have a total of 83,000 in debit. So those are our actual manufacturing overhead expenses. And then over here on the credit side is what we've applied or allocated is 67,000, and I can see I have a balance of 54. So what I can see here is that the actual, in this case, the 83 is greater. So the actual is greater than the applied or the allocated. Let's call it allocated. So that means I am under applied. So that meant the amount that went into work in process and then into finished goods and then into cost of goods sold, that number is too low because I didn't allocate enough to that job, which means the price that I charged is probably too low. It's not covering my costs, or it's not getting me the profit that I wanted, and so that's going to lead to lost profits. If, on the other hand, my actual was greater than my allocated, then I'm over allocated or over applied, under allocated up here, sorry. That means the amount that went into finished goods and therefore into cost of goods sold was too low. So I didn't put enough in, so cost of goods sold is too low, which means the price I charged, I'm sorry, this one is too high, right? Actual is greater. Actual is less than the allocated, so the allocated is more. So the amount that went into cost of goods sold is too high. That probably means the price that I charged is too high. And if you don't have any competition, maybe that's not too bad, but if you do have competition, this probably means lost sales. So if your price is a lot higher or a lot lower than all of your competitors, that probably means you've got something wrong here in your overhead allocation. Maybe you need to pick a new cost driver, maybe you need to kind of look at some costs over there. But in this first case, if it's too low, you can't go back to people that you did business with 6 months ago and say, hey, I didn't build in enough, can I charge you a little more? But so that won't work. In this one, here's what we ended up with at the end of the year. Again, here's my actual on the debit side and my allocated over here on the credit side. So in this case, I end up with a balance on the debit side of 1,000. So that means I am under allocated by the difference there, which is $1,000. So that means cost of goods sold is too low by $1,000. So that means I need to fix that so that next year when I'm doing my planning, I've got the right number. And so I need to adjust that so that the numbers I'm reporting on my financial statements are correct as well. So and cost of goods sold is an expense, and you probably learned way back in the beginning of accounting that you never debit or you never credit an expense, but fixing this might be one of those. In this case, though, we don't have enough in cost of goods sold, so we're going to debit cost of goods sold for $1,000 to correct that. We're going to credit manufacturing overhead because we need this account to have a zero balance. Right now it has a debit balance of 1,000. We need it to have a zero balance, so we'll credit it by 1,000, and that will clear out manufacturing overhead and make sure I'm reporting the correct number of my cost of goods sold. If I were over allocated, I would just flip those, right? I would be debiting manufacturing overhead and crediting cost of goods sold. So that's what I would do to fix that if I was over allocated. So pretty straightforward. It's just going to be a matter. It's always going to be these same two accounts. It's just a matter of which one you're debiting. But in either case, I'm trying to correct cost of goods sold and clear out the balance in manufacturing overhead. Okay, last thing I want to show you for this chapter is how we do job order costing for a service. So I think our example here is an accountant, so that would be a good one. So they don't really have inventories, right? So we really just have direct and indirect costs. So your direct costs are just your direct labor, since they won't have any direct materials, and so this is going to be salary and or wages. Your indirect costs is really everything else. So all of those, we don't really call it manufacturing overhead because we're not manufacturing. It's just direct and indirect costs. So everything else goes under indirect costs. More than likely, though, you're going to allocate these the same way we allocated in the manufacturing overhead. So this would be, you're going to allocate these based on percent of direct labor dollars or direct labor hours, similar to what we saw in the manufacturing overhead. So it's the same process as that predetermined overhead rate that we did with the manufacturing. So you'll estimate your cost ahead of time. You'll estimate the amount of direct labor hours or direct labor dollars and come up with a rate that way. They put a section in here about pricing decisions, and this applies not just to service business. This really applies to everybody. So everybody is either a price setter or a price taker. Okay. Now, if you're taking micro econ right now, this is going to start to overlap because we're going to do some of this in there as well. If you're a price setter, that means you have differentiated your product, or you don't have a lot of competition, or yours is different enough that people are willing to pay more. So if that's the case, then you can take your total cost. Here's how much it costs me to do it, plus your target profit. I want to earn X amount of profit. Add those two together, and that's the price that you charge to your customer. If, however, you're in a highly competitive business and people aren't willing to pay that much more for yours, then you're a price taker. And so you kind of have to take what the market price is. So you take the market price. So here's what people are willing to pay, essentially. Take off, subtract the profit you want to make, and the number you get there is your cost. So you have to then try to figure out a way to make your cost come within that number. So you kind of set, you know what you're going to charge, you know what you want to make, and then you have to find a way to make your costs come under that. So it depends a lot on the amount of competition you have and the type of product you have. So this is a really important concept, and as we get into managerial, we'll talk about that a little bit more, and also in econ if you're in there. But for now, they put it in here with the service, but it really applies to everybody. So now let's just do two quick problems for a service company here. Roth Accounting pays Jack Smith $90,000 per year. What is the hourly cost to employ him if he works 30 hours a week, 50 weeks a year? So if he works 30 hours per week times 50 weeks per year, that means he's working a total of 1,500 hours per year, okay? So the first question says, all right, if we pay him $90,000 a year and he works 1,500 hours per year, we're paying him $60 an hour. The second thing said, what direct cost would be applied to client number 507 if he works 15 hours to prepare their financial statements? So then all we do is we say, all right, he worked 15 hours on this job. We're still using job order costing. And his direct cost is $60 per hour. So the direct cost is $900 for this client. But we know that we're going to charge the client for more than that because we've got to cover all those indirect costs too, right? So this one says, assume that all of their accountants we're anticipating 8,000 direct labor hours, and we're anticipating $96,000 in total indirect costs. So that's everything other than the labor. What is their predetermined overhead rate? So same way we did it for the manufacturing. We take the total estimated indirect costs divided by the estimated number of direct labor hours. I think, yeah, we're doing direct labor hours in this one. So if we anticipate $96,000 in indirect costs and we anticipate 8,000 direct labor hours, we're going to apply this at a rate of $12 per direct labor hour. So for every hour somebody works on a job, we're going to assign $12 in indirect costs as well. So if we look at the same client, Jack Smith worked 15 hours. So on client number 507. So 15 hours, and then we use this predetermined overhead rate of $12 per hour. So we'll have 180 in indirect costs. And then the total, which they didn't really ask us for in here, but if we go back here, he worked 15 hours on this, so there was $900 in direct costs. So the total that this client is going to get billed is the 900 in indirect and the 180 in indirect. So the client will get billed $1,080 is the total cost. So that's how they'll figure out how much to charge that client. And they can't do that until they understand all their costs. So there we go. So that's chapter 19.